Exercise 1113 refers you back to exercise 1111. When we did 1111, we did the indirect method, so we started with net income. 1113 says, please do the direct method. So instead of starting with net income, we start with cash received from customers. So let's take a look. And they tell us the cash received from customers is computed as such. Take the cash from sales of $2,050,000 and then adjust for the change in accounts receivable. So in this case, accounts receivable went down, so cash had to go up. And it did so by $8,000. So cash received from customers, $2,058,000. $2,058,000. 205800. Okay. Now, cash paid to suppliers. Your book says cash paid to suppliers. You take the cost of goods sold, and remember that's from the income statement. So we take cost of goods sold, and that was $1,150,000. Then our inventory went up. So our increase in inventory went up. So we add the increase in our inventory. So inventory went up, we add that, and that's $25,000. Because we paid that much plus the additional $25,000 for inventory, and then we subtract the increase in accounts payable, because the only thing that makes an accounts payable go away is if you pay it, and that's $13,000. We subtract that, and when we do that, we come up with cash paid to suppliers of $1,162,000. Cash paid to suppliers, $1,162,000. Next, we have cash paid for operating expenses, and they tell us that our operating expenses, and it's on the income statement that you'll find at the bottom of page 543, our operating expenses are $660,000. Now let's look at our balance sheet and see what that could include. Well, the only thing in the balance sheet that could include would be prepaid rent, because nothing else would fall into operating expense. So our prepaid rent went down, so our operating expenses, our cash went down, okay? So we had a decrease in prepaid rent, $3,000, so that was $3,000 we didn't spend, so that's $657,000 in operating expenses. When we're done this, I'm going to show you the way I do it, which I think is easier. But I wanted to show you the way the book did it so that you have some consistency there. And last but not least is cash paid to suppliers. Now, cash paid to suppliers is linked to cash paid for income taxes. Cash paid for income taxes is linked to income tax expense. And our income tax expense, if you look at the income statement, was $50,000. So we paid at least that much. And we also paid some of our tax payable, and in this case, our tax payable went down. And the only way tax payable goes down is if we paid it. So we spent $9,000 more in cash for tax payable. And when you total those together, you come up with $180,000, which is exactly the same number. Now, that's the book way of doing it. Let me show you my way of doing it. Either way will work. I just think my way is a little more commonsensical. Cash received from customers. I start with sales of $20.50. Using just common sense, did we have to collect our beginning accounts receivable during the year? Of course we did. So I'm going to add my beginning accounts receivable of $54,000. The accounts receivable I didn't collect during the year were the ending accounts receivable. So I'll subtract that. I come up with the same exact number, but I think it's a more commonsensical approach. We collected every dollar from our customers, plus we collected all the money that they owed us coming into the year, minus what was still in accounts receivable at the end. That's the way I like to think, but that seems to make more sense to me. Either way works. You see, you come up with the same exact number. Cash paid to suppliers, same sort of deal. I start with cost of goods sold because it's the only place that makes sense. Cost of goods sold was $1,150,000. Now, the cost of goods sold included inventory that I started with, that I paid for last year, and inventory in my ending inventory that I'm going to sell next year. So I'm going to subtract my beginning inventory because I paid for that last year. So I'm going to subtract that $60,000. Likewise, I have ending inventory of $85,000 that I paid for this year that'll end up in next year's cost of goods sold. So I'm going to add that. And I'm just applying common sense. That's what I paid. I paid that last year. That will show up on the income statement next year. It's in my ending inventory right now. I'm going to make the same sort of assumptions about accounts payable. Assuming you're doing business with reasonable people, you had to pay your beginning accounts payable to get more goods shipped to you. So I'm going to add that, $42,000. I didn't pay my ending accounts payable. That's why it's called ending accounts payable. I'll pay that next year. So I'll subtract that. And when you do that, you come up with $1,162,000, which is the same exact number. I just think doing it step by step and thinking about it logically makes life a little easier. My opinion, you're welcome to use whichever method you like. Now, cash paid for operating expenses, and this holds true for anything where you have it prepaid. So we're going to take operating expenses, and we had a prepaid that was in there. So operating expenses was $660,000 on the income statement, to which I'm going to subtract my beginning prepaid because I paid that last year. So I subtract the beginning prepaid of $7,000 and I add the ending prepaid because I paid that this year, but I'll use it next year. And that's $4,000. So we come up with a total of $657,000. It's the same number, it's just a little different way of thinking about it. I think it's a little easier. Cash paid for income taxes, the same thing. We're going to take our expense of $50,000. We're then going to add to that our beginning tax payable. Trust me, if you're still in business and not in jail, you paid your beginning tax payable. So we're going to add beginning tax payable. And that was $15,000. The tax you didn't pay was the ending tax payable. And that was $6,000. So when you add that together, you come up with 65 minus 6, 59,000. You come up with the same exact number. It's just, in my opinion, a more commonsensical approach. Either method is correct, either method is accurate. Whichever one fits in your head better is the one you should use.